I'm going to beat up on you a little bit because small caps have not been the stars this year on Wall Street. Look, we've got Dow hitting record after record. The larger caps continue to outperform. Does this change in the second half of the year, or do small caps stay behind?
Sure. Well, in 2013, small caps did very well, and so it was a great year for them. As a result, we had valuations that did come up, and they were roughly about 19.5 times next 12 months earnings, so they are relatively expensive. But we really haven't seen a lot of the leverage and earnings growth come through yet. We do expect that to happen this year.
Why?
Well, we're looking, the current consensus for the second, third, and fourth quarters is for 12% growth, 16% growth, and 20% growth, mostly from economic factors, number one. And number two, we are just seeing a better employment picture as well as economic picture, which will help the small cap stocks do well this year.
Let's name names. CAVIUM is one stock that you like. It's focused on network security,
right,
up about 30% in the past year, so
right,
a decent run there. It trades more expensive than its peers.
Sure,
Does
sure.
growth justify that?
It does. It still trades at a discount on a PEG ratio, PE to growth ratio. And what we're looking for is the company on their base business to double the size of the company in 3.5 years. So we're still looking at 30+% growth for the next couple of years just on their base business. And they do have some very exciting new products coming out. One is the CAVIUM Thunder product, which is getting into the cloud server market, which Intel owns 96% of. So if they can get a couple percentage of share there, it's going to add tremendously to their growth because that market is so big.
Since you mentioned it, do you prefer PEG ratios when you're looking at your stocks because they are small cap?
Often, but we're looking at pure growth companies, so those secular growth companies. And so we do look at PEG. Some of the best companies might look expensive on an absolute basis when they come public or shortly after, but the growth really has to justify that. And what we do is try to find those companies that are going to beat expectations and have those earnings revisions move up dramatically so they're not as expensive in the future.